Good morning, everybody, and I'm very glad you could join us for, I think it's going to be a great panel on investing in healthcare space. I'm Greg Brown. I'm finance faculty here at Kenan-Flagler, and also serve as the research director for the Institute for Private Capital, which is very focused on, as you would guess, kind of private capital formation, private equity funds, venture funds of the sort. So I wanted to start the panel today just by giving a very brief overview of kind of what private investing has looked like in the healthcare space over the last 25-ish years or so. So I've got a couple slides. So this is data. We're lucky to have access to very high quality data set on private funds from MSCI. That if you're familiar with this space, it all used to be the Burgess data set, and it's sourced directly from LPs. And so it's investor experience, so you don't have to worry about a lot of the kind of weird, funky things you get from self-reported data or other issues. So you can kind of believe this data that I'm going to show you. So the first one here is just the total amount of fundraising that has happened by vintage year into private funds, both buyout funds and venture funds, and actually growth funds as well. And so you can see that it has grown substantially over the last 25 years, and sort of really reached a peak about 5 years ago. And so we see that both in terms of the number of funds as well as the capitalization of funds. So the left axis there is capitalization in millions. So we had a vintage year back a few years ago, or a couple vintage years that were up in the sort of 40+ billion range in terms of total money being allocated to private funds. If we look at performance, I would say has been generally pretty good in the healthcare space, and I think that's part of what was attracting a lot of investment, increasing investment over the last 15 years or so. Or maybe I should go back a bit and say, of course there's been a meaningful decline in fundraising over the last couple of years. That's not unique to healthcare space, and that's something we'll talk about in the panel quite a bit. But if we look at performance, this is performance by vintage year, and so I don't have the last 5 years on there because we just don't think those vintages are mature enough to say anything interesting about in terms of performance. The top line, the red line, is IRRs. The blue line is what we call direct alphas. Those are essentially market adjusted performance. So if you benchmark sort of the precise cash flows that you're putting into a fund and getting out of a fund to a public benchmark, in this case the MSCI All Country World Index, it's how you would have done in comparison on an annual percentage basis. So IRRs, it's actually over the last 25 years, there's never been a vintage that didn't at least break even. And you can see that the kind of average return over this period was like around 12-13% or so in terms of IRR. Academics don't like IRRs because they're not really returns and have all kinds of weird properties that we don't like. So that's one of the reasons we like these direct alpha calculations, is they tell you kind of more precisely how you would have done versus investing in public markets. But you can see most of those are positive too. So there was these vintages back in the early aughts where there were negative direct alphas. There were some vintages that just very recent, the 2019, 2020 vintages, but for the most part, you were earning a positive spread to public markets, and the average over this time period is about 2%. So not a huge amount, but sort of on par with what we see with other private investments over this time period. And then the last thing I want to show is deal level data, which I think is super interesting because we also, with the MSCI data, get to look through to the portfolio. And one of the reasons it's interesting to look at deal level data is what I showed you before was for funds that are specialized in the healthcare space. And the way MSCI defines that is more than half the portfolio is in healthcare, GIC sector. But there's obviously a lot of deals that are being done by folks that have a broader sort of specialty or just generalists. And so if you look at the deal activity over time, it's grown much more than what we have seen for specialized healthcare funds. And so, it's almost like exponential growth there in terms of deal activity. And I think that's because returns were quite good, attracted people into that space, and sort of the set of of investments, people considered in the healthcare space continued to broaden. And that's good news and bad news. Like I said, it's good news if you're trying to raise capital in that space. It may be bad news if you're investing because it's gotten to be a much more crowded investment field. And so you can sort of see that the returns as measured by IRRs have sort of leveled off. And you also note that the average IRR here for sort of all deals is a bit lower than what you see in specialized funds. And that's something we see across the private market space, that specialized players tend to do better on average than generalists. And so it's interesting that we see that in healthcare in particular. All right, so that's all I wanted to show as sort of a backdrop, just to level set in terms of what we're talking about. So do that. And I think now it's time to turn to our panel. So excited to have a really fantastic panel. We're going to have lots of different perspectives and insights across different parts of the investment space and geographies and all kinds of things. So immediately to my left here is Mary Gunn. Then we have Ksenia Simpson and Wilson Orr. And I'm going to let them introduce themselves and give a little bit of their bio, especially the part that's relevant for this discussion, and then we'll get into the Q&A. So Mary, why don't we start with you?
All right, thanks, Greg. Mary Gunn here, based out of North Carolina, and what's relevant about my experience is that on the venture side, I serve on the investment committee of a major university, and we do a lot of investments in life sciences and innovation. And then that's focused on pre-seed to seed. From the buyout side, I've been advising private equity, huge variety, across 13 years, entirely focused in healthcare. And on the growth side, I serve on the board of a large publicly traded growth investor with a heavy concentration in life science. And I do a lot of work in the US, but also in Europe and in Asia. Very nice to be here today.
Mm-hmm. Great. Ksenia?
Great. I'm Ksenia Simpson. I'm with Hatteras Venture Partners. We are an early stage healthcare focused fund here also in the Triangle area. And we invest nationally. We are based here. So Hatteras focuses across all of human healthcare. We invest in therapeutics, devices, healthcare IT, some research tools, some diagnostics. A little bit more than 50% of that is in the therapeutic space, so sort of biotech, biopharma, and that's where I primarily focus. So I think most of my perspectives today will be coming largely from that angle, although some of that might be applicable to other areas of healthcare. That's probably all you need to know about me for now.
Hey guys, Wilson Orr here. Graduated from Kenan-Flagler in 2014. Spent the last decade in healthcare, middle market, private equity, mostly focused on growth platforms in the healthcare tech space. This year, part of the founding team of Ironleaf Capital. We're a specialized healthcare tech fund, exclusively focused on healthcare tech, and I think that's just emblematic of private capital markets in general. People becoming more specialized.
Yeah, that's great. See, I don't know if your mic is on. Could you guys tell if your mic is on?
Sorry.
Okay,
yeah.
Good. Just want to make sure people can hear you. All right, so let's start with sort of a fairly broad question, and we'll start narrowing down into more specific things. But give me a sense of, from your vantage point, which are a little bit different for each of you, what are the most important changes in how capital is flowing into the healthcare investment ecosystem today compared to, say, 2-3 years ago or so? So I don't know who wants to kick that off. Maybe Mary, you've got a very broad view of that. So
I would say two things that I've observed. It's a lot more competitive globally, with China being a lot more competitive in terms of attracting capital. And then from a fundraising perspective, it's generally been in the decline for the past 3 years. Mm-hmm. And what I've also observed is in terms of early stage, pre-seed and seed is fairly robust. Where there are gaps I see is from Series A to B. There are a lot of, it's tougher to find someone who's willing to lead in those rounds. And so that's where I see some of the pressures.
And can I just do a quick follow-up on that? Is that because there's sort of a scarcity of new capital being committed, or is that reluctance on the part of GPs to do new deals, or are those two things so interrelated it's hard to tell what's driving it?
I think in part it's because there's that bifurcation effect that you alluded to. So I guess I was referring to on average. But I guess the thing that you should do in this environment is never look at averages, because the gap between the median and the mean is just widening across 3 years.
Yeah. The K-shaped economy that we're seeing in so many places. Yeah. Great.
Great. Yeah, so from the biotech perspective, I think, as you were alluding to, I think there were a lot of companies formed during the peak of the pandemic, and lots of capital was flowing from not only specialists, but also generalists into the biotech arena. There was a lot of enthusiasm for biotech at that time. And then there was a pretty big drop-off from that. I think we would argue that there were too many companies formed during that time. There was sort of an over-exuberance and a bit of a frothiness to that time period. And so although it is tougher out there right now, I think we would argue that's a good thing. It's returning to more of a rational level. So there are now, I think there were like 900 something companies around the pandemic timeframe. That's now dropped to 700 something public biotech companies. And so you have less competition for investor, not only capital, but also attention. There's only so much that I think the space can handle. And again, I think that's a really good thing. I think returning to a more rational place is good for reasonable valuations, measured deployment of capital. I think would say we've always approached it that way, and so we think it's overall a positive, and we do think there's sort of a stabilization of sorts taking place now to sort of a pre-pandemic levels, kind of across the board. In terms of specific deals and sort of series of deals, I would say the same thing. I think we've sort of seen almost a combination of what used to be an A and a Series B are now, in cases, being combined into one round. And so you're basically securing and pre-committing for that risky period of having the funding to get you through very important inflection points in terms of your growth in clinical data and proof of concept data. And so you see a lot more people kind of going in on cahoots and having this big Series A, which is really what a Series A and B maybe used to be, but it is tranched. So it's sort of, there's sort of a sneaky backside to that where that money is committed, but really only deployed upon reaching certain milestones. So yeah, that's probably a good place to pause. But I agree with the comment on China. I think China is getting much better at competing with us. They are, if you look at deals in license or drugs in licensed from China over the last couple of years, it's skyrocketed. A lot of pharma companies are choosing to buy assets from there. And I think we would, again, argue maybe that's a good thing. I think in a free market, they don't necessarily need to care where it's coming from. It just needs to be a good drug at a good price. And maybe this could be a rallying cry of sorts for us to continue to step up our game and maybe have support on a federal level to step up our game to continue to be competitive. So so there's a lot going on, but those are a few comments.
Yeah. So can I do one quick follow-up? So this interesting idea of sort of the mega Series A, which is really a combined Series A. Anyway, do you think that is sort of a cyclical thing? That's just because it's been a tough environment and people worried about being able to raise that Series B, or do you think there's something that's sort of a secular shift in terms of how people want to raise Series A money?
It's a good question. I mean, I think we'll have to wait and see if we return to smaller rounds or not. I think it's a very reasonable way to do it. So if you think about, again, in biotech, we're talking about pre-revenue companies. In your currency is really value inflection, the biggest of which really starts to happen when you're using your drug to see how it actually does in patients in the clinic. And so the Series A funding tends to come sort of right as you're entering the clinic or just before that. And it used to be that you kind of would get through a little bit of that and then need to raise your B, but you haven't quite shown that you have real potential with your therapeutic yet. And so in many ways, it kind of makes sense to have the capital to get you to the really meaningful stage. And it makes sense to get your sort of partners around the table kind of predetermined for that. So I think I think although we, as you know, a smaller fund, maybe it's a little bit more challenging to play in some of these bigger rounds. I think overall it's a very reasonable approach, and it does sort of lean into your bifurcation also of like, you have a lot of people really believing in certain areas. Maybe that makes it more difficult for others to even have a chance. But it's a very rational way to set that stage of funding up. So I feel like it's going to stick around, but you really never know.
Yeah, no, it's interesting.
Yeah.
I mean, it because I think sometimes, you know, crises or problems sort of lead to innovations that end up sticking around. So yeah, I'll be curious to watch.
Yeah, same.
So Wilson, tell us what's happening in buyout land.
Yeah, I'd say if I had to sum it up in one word, it'd be more disciplined relative to 2 to 3 years ago, where businesses that were telling grand narratives didn't have much measurable success. You know, they didn't have any practical application. We're raising a lot of capital, and it's become a lot more disciplined. From my perspective, we're a little bit more. We're kind of stuck in the middle of the VC and then the mega cap buyout or the IPO land, and so it's hard to get deals done, but it's steadying. And what I'd say that's created is a flight to quality, and it's a little bit like like youth soccer of everyone like tracking the ball, and you know, it's like every deal that we look at, it's like the same 20 names that are, you know, submitting IOIs, getting to the next round, spending time on things. And what you see is that the people that are getting done, it's actually still at pretty healthy multiples, but they have a unique angle, they have a relationship, they can de-risk what's the key question. And so I would say that's still disciplined investing. It's just a lot more work being done over much longer diligence periods versus let's preempt this deal and sign it up in 2 weeks without having done anything, and we own this asset that doesn't really have proven product market success, which was what 2 to 3 years ago was. So I think from an investor standpoint, it's constructive. It just is hard.
Mm-hmm. Yeah, I mean, maybe one way to think about it is there was a lot of kind of like healthcare, private investment, tourism going on at the peak for people coming in who weren't necessarily didn't have that discipline in the space and were overpaying or, you know, doing deals that maybe they're regretting now. And the established players like you guys are, you know, sort of having to wring your hands a little bit and wait for things to normalize, which it sounds like they are. Now, you know, at least in terms of the type of deal, but you know, I guess it would be nice to have valuations better than they are right now. But we'll come back to that. All right, so let's dig into this question then of more on the cyclicality and sort of this what I'll describe as a challenging liquidity environment right now. So as of sort of right now, are you starting to see timelines extend, or are they still let me rephrase that. Are you starting to see timelines shorten, or are they continuing to extend still? I just saw a graph yesterday that shows that we're sort of at like a record long time for private companies, or time to exit right now for private companies. And so then given that what you see there, you know, how does that affect how you evaluate new investment opportunities? And I'll just put that as a toss-up for whoever wants to jump on it first. Go ahead, Wilson.
Yeah, you know, in PE land, we always say 5-year exit holds, and I think it's 5 to 7. And we got to be realistic when we look at returns that it's probably going to be 7, especially in healthcare. It just takes longer. The sales cycles are longer, and so I think that it's gonna stay. We are coming out of you know, this kind of overhang from COVID in the VC world, where those businesses are starting to come to reality that they're not going to have success. and so that's created a little bit of deal flow in the market, but the IPO market hasn't really opened up. And so from my standpoint of being kind of back to what I was saying earlier, stuck in the middle,
Yeah.
where you're picking up these businesses at an inflection point and recognizing there's a lot of real work to be done to realize a realistic return. And I know you said on the charts up there that academics don't like IRRs. Well, neither do GPs. We like MOIs.
Mm-hmm.
And then our investors, the LPs, they like DPI. So we're kind of just like caught in this issue of trying to be disciplined, but recognizing that we're going to have to be realistic around timelines.
Can I build on that too?
Bet.
Yes, so I would totally agree. I think with the IPO window closed, again, in biotech, historically and really realistically, you have M&A and you have IPO, right, as potential ways to get your money out. When the IPO becomes more challenging, you become over-reliant on M&A, perhaps, and in a way that that M&A process just can't support the entire biotech industry because that actually stays relatively constant. There's a little bit of up and down in that, but really you have a certain number of pharma companies and they have the bandwidth to do a certain number of deals per year. And again, there's a little bit of choppiness to that, but it's not nearly enough to compensate for a change in the broader market dynamics in terms of the public markets. And so your chance of exit drops drastically, and it's a real challenge. And so that means you're definitely carrying things longer. And I think there's I've noticed really very recently sort of a simmering conversation in biotech land about how we need more creative business models and paths to profitability. Then, M&A is really great and everybody's really happy when it happens. But there need to be other, maybe more creative approaches. And one company that we had this year that we think had an interesting solution to that was essentially they were exploring IPO, they were exploring acquisition, but in the end, they were sort of bought out by an incredibly wealthy group of private investors. We called it a private IPO, which is kind of a nonsensical, but it was essentially a very wealthy group, including sort of Bezos, Jeff Bezos, and K5, and a number of other really wealthy partners. Basically bought all of us early stage investors out, and then there was an option to roll some over, or you could get out, and it's almost like a private equity type deal at a very large scale. And so we thought that was, for instance, a very interesting solution, and we think we'll see more kind of new things coming out, new models coming out, and things like that.
And so was that deal? I mean, were they looking to be sort of like long-term buy and hold investors, or did they think that they had sort of a unique value creation strategy that?
Yeah, I mean, this is a company called Histosonics, and it basically uses sound energy to destroy cancer cells and other sort of malignant cells. And it's just recently launched on the market. Its revenue increase has been good, but they think that the company could be worth trillions someday. And so their idea is to hold it for a long time, and they're willing to do that. They understand that people who have been holding it, I mean, the company was started like 17 years ago or so. So it's like those people are fatigued. We were one of the first investors, so that includes us. But they see a lot of value, and whether that means they're going to hold it and someday take it public, or someday sell it for 20 billion plus, I don't know, or wait for it to truly reach that very high level of value and profitability, I think remains to be seen. But that's how they're viewing it, sort of they're taking it into its next chapter. Yeah. And we were happy about it. So yeah.
That's interesting. It's sort
cool.
of like consortium permanent capital or something.
Yeah. Like, I think your private equity is like a continuation type of
the
CV.
Yeah. That's interesting.
So anyway.
Yeah. So Marie, what are you seeing?
I agree. The two things I would like to add to that is semi-liquid assets. So the secondary markets, it's now 600 billion AUM. So one of our portfolio companies, we've had multiple liquidity rounds just through the secondary markets, and I don't think they're going to go public anytime soon. So they're a tech company, and we're starting to see some of it in healthcare, but I think healthcare, life science follows tech when it comes to these things. So I expect to see more of that. And also that, to go back to your original question, I think there's according to one of the reports that I saw, it's like $1 trillion trapped in older vintages in private equity. And because of that, at least certainly on my side, I'm seeing an effect where private credit has done really well in fundraising, and it's competing, right, for capital. And, the returns are quicker, it's structurally more flexible. I've also seen data whereby I think the dry powder there is like more than 500 billion, which is more than the dry powder currently in venture in general, right? But then we're also seeing some of that being rebalanced because we're seeing, I think somebody said cockroaches in private credit.
Right. Yeah.
So
certainly a lot of concerns that things are bubbly there now.
Rebalancing occurs, then maybe some of it will flow back.
Yeah, no, I mean, it's the growth in AUM for private credit and infrastructure to some extent, but especially private credit has been really staggering. And a lot of that being driven by, I think, retail demand, because the private credit makes a good retail product. And so lots of people, I think, are worried about that. And it is, I think, pulling capital away from buyout venture space because, it is an alternative in some sense, an alternative, I guess. So will definitely be interesting to see how that plays out. So yeah, maybe an oversupply of capital in the private credit space and an undersupply in equity right now.
And I can attest for how many emails a day I get from private credit BD people to go get drinks or have coffee. There's too many of them.
They're getting starved for deal flow now. Yeah. It's interesting. Yeah, okay, so let's talk a little bit about return expectations. So I showed that historically there's been very wide variation in returns, sort of by vintage. Some of that is just what's happening broadly with, sort of business cycle, market cycle type stuff. But there are sort of return components that are unique to the healthcare space. So and I think you all are going to have very different answers on this because you're in different places of the ecosystem, but I think it would be interesting for us to hear sort of how do you think about return expectations and underwriting either deals or funds and in your case, Mary. So I don't know, you're the broadest investor here, so tell us about how you think about return expectations in healthcare versus other spaces or just in general.
I think I have to be careful what I say here. I think everyone has alluded to, the pandemic highs and the entry multiples were sort of quite high. And so depending on the vintage, you sort of ideally would want your exit multiple to be higher. And if not, you're a little bit stuck. And I'll just sort of put that out there.
I mean, I kind of think like we get some data on fundamentals, especially like buyout fundamentals. And I mean, I think that is kind of what's gotten things very stuck right now is that people were paying very high multiples. The way you get out of that is either with margin expansion or revenue growth, and those can just take time. I mean, especially revenue growth just takes time. You got to really grow the business. So, I mean, it does feel like that we've seen of recent exits, we've seen much more of the value creation come from revenue growth than from multiple expansion. So I don't know. I mean, Wilson, is that sort of consistent with what you're seeing?
Fully consistent.
Yeah.
I mean, I don't think we underwrite any multiple expansion at all. And even, we're entering businesses that might have 5 million of EBITDA. So they're subscale businesses that we're even not underwriting multiple expansion. From a return standpoint, I think we're 3 to 4x. But, there's a continuum. We're looking at how confident can we be on the downside that we feel like we can eke out a 1.5x, and then what's the opportunity to make 5x. And I think you're always having that conversation when you look at any deal.
And so you target multiples, not IRRs when you're looking at.
100%. Yeah. Because I think you recognize it always takes a little longer. I mean, just for context, we're entering businesses that have 5 million of EBITDA. They've been founder-led for 10 years or so, and there's a professionalization, there's team build, there's tech infrastructure, just to help the company run faster.
Yeah.
And then that's when we start aligning on the strategy and the product extensions, maybe doing some M&A. But sometimes it's 2 years before we finally have kind of gotten the company ready to go and revved up. And so imagine trying to underwrite to a 5-year return, and you're 2 years into your hold period, and you now have the team in place. Like it's going to take longer.
Yeah. What looks good in venture these days?
Well, I think on any individual company in biotech, we're always shooting for still the classic venture-like return of 10x. But that's with the understanding that there's going to be a very high attrition rate. So, I mean, the classic model of, you invest in 10 companies, maybe 2 to 3 of them hit really big. Some of them are zeros and some of them are more modest. Is true. That's on any individual kind of investment thesis that we create for a biotech company. We want there to be a reasonable path to that type of a return on a reasonable timeline. Hatteras kind of mitigates some of that with, I mentioned we as a fund, as a firm, we invest across other areas of healthcare. And so more on our healthcare IT side, it's much more of a, you're mostly investing in companies that are generating revenue. You're looking to grow that revenue. And those are usually more of a 2 to 5x goal. And so it's lower return, lower risk. And so we kind of balance our overall success there. I mean, I think on a fund level, I think we are pleased with 20 to 50% is great, but I don't know how realistic at this time. It all kind of it depends, but those are the goals.
And how many deals per fund do you target?
Yeah, so I think our current fund, Fund 7, which we just closed, it's close to a $200 million fund. We're targeting, it's probably going to end up being around 16 portfolio companies in that. The range is 15 to 20, but it'll probably be around 16, 17. But of course, there's attrition, and that can allow you to pile more into winners, or it can allow you to do maybe another investment. So there's always a little bit of a flexibility, but that's kind of what our current fund looks like.
Great.
That's a good thought, because we're at 5 to 6 per fund. So we've got to keep that band really, really tight.
Yeah.
And you got to make sure that, look, if we buy this business and it just kind of keeps doing what it is doing, that's probably like a 2x. We pull 1 or 2 value creation levers, that's how you get to the 3x. And if it works out really well, you can at least see a path to something above it. But the band has just got to be much tighter with less portfolio companies.
Yeah, for sure. Okay, so I've got maybe 1 or 2 more questions I want to ask. I actually have a giant long list of questions to ask, but I want to give an opportunity for folks to ask questions from the audience as well. So I'm going to ask 1 more question and then open things up, so be thinking about questions for the panel. So let's move a little bit more, and we already just touched on this a little bit, talking more specifically about sort of subsectors, technology type issues. So definitely signals in sort of health tech investment that things are thawing a bit. And I guess indicators for that are sort of larger deal size, some IPO activities. I mean, IPO market's been really cold for a really long time. Interesting factoid, second longest cold stretch since we've been keeping data for the IPO market. But some signs, like just the last few months, that things are thawing a bit, maybe more in tech than healthcare, but some green shoots there. And then definitely some interest around technologies in terms of like AI type stuff and kind of tools innovations there. So So sort of thoughts about, are we seeing something that looks like a real genuine thawing? If so, and kind of what, kind of subsectors, what are the spaces that seem particularly interesting, relevant right now? And again, I'll throw that as a toss-up. Yeah.
You want me to start? Sure, I'll start. So, healthcare tech, we spend time across payer, employer, provider, and pharma end markets. And the way we think about it is investing in healthcare tech and tech-enabled services that are alleviating pain points in those end markets. So the trends in those end markets and the implications are informing a lot of where we're seeing opportunity. I mean, I think the worst off is the provider market. They're just under tremendous pressure. They're going to do anything first with EMRs, so like we're not going to go compete with Epic. RCM's a place to go, GRC places outside the EMR, but those are kind of picked over a little bit right now. The payer market's been under a lot of pressure, but employer is really a very attractive spot. They want to spend on resources that can provide a better solution to their employees. And so employer cost containment is a big trend that we see a lot of opportunity. And then I think the pharma market's probably the most attractive just because they're well-funded. It's funny to some of these other panelists that talk about uncertainty and disruption. From our standpoint, tech-enabled solutions that help alleviate those pain points, I kind of see, I hear that as opportunity, and at least a buyer that has money and capital to spend on resources. So that's kind of how we think about the opportunity across the different end markets.
Yeah, I mean, I think since the pandemic, I think you had a big, this is very much a biotech-centric view, but pretty much every investor in the biotech space over the last few years has been very, what we call asset-centric, so really focusing on specific drug products. How far are you from the clinic? How far are you from those value inflection points that we've been talking about where you show that your drug works and have the potential to be acquired? It's been very kind of a practical view. During the pandemic, there was much more of a heyday of investing in brave new world, sort of early stage, exciting new platforms that could eventually generate a whole pipeline of exciting new therapeutics, but we're quite early and a lot of those didn't play out. And so that kind of made people a little bit more wary. I would say the exception to that is in the AI drug discovery space, and particularly, we had a little bit of a peak in this a few years ago, but it's really coming back now. I think just this summer and fall, we were seeing many mega rounds that are in the AI drug discovery space, but their base of investors is really very much like tech groups, not your classical life sciences focused groups, and so this is sort of, I think, a really interesting inflection point that's going on. There's a lot of really all the major tech giants right now, Google, Microsoft, Facebook, Amazon, Salesforce. I mean, they're all getting into this space now, and the tech investors are also very excited about the potential of the transformative power there. And so those rounds are much bigger. There's some people that are worried that might be a bubble. But some people that are very excited about how that world is going to unfold over the next 3 or 5 years, and everybody in tech, I think, versus there's at least an extra zero in the tech world for everything that's done versus biotech. So those companies that can kind of play into that angle are doing quite well.
Yeah, that's interesting. So Mary, I bet you get the opportunity to see just about everything that people are doing everywhere in the healthcare space. So what seems particularly interesting or hot right now?
Well, I'll talk about the extremes that I'm seeing. On the growth side, we're actually being pitched 2 employee unicorns. This is actually happening, meaning that there are 2 employees and the valuation is in excess of $1 billion,
That's
especially
amazing.
in drug discovery. And I'm not saying that we've invested, but I see that as being a bit directional, right? Because they're able to essentially, being not a very tech-savvy person, I asked them to explain, well, how is this happening? And the explanation is that they're able to, you have to think of the AI as coworkers instead of tools. which is very interesting. The other extreme is someone senior at a particular stock exchange has said to me that he believes 2026 will be a super cycle of IPOs because of I think it's like something like 4 trillion trapped in older vintages.
Yeah, there's just such a backlog of
Yeah,
things that
and
need to
then
go.
if interest
Yeah.
rates go down in economic conditions,
Yeah.
so not my words, but
Yeah. I mean, it's a mystery in some sense. Like we have this IPO model that sort of predicts what IPO activity will be, and it's predicting way more IPOs than we see right now based on, what market returns have been and first day returns and sort of the things that historically have been good indicators. So yeah, I think when the dam breaks, there's going to be a ton of IPO activity. So hope I didn't jinx it. So okay.
And Greg, maybe one thing I
Sure.
would add, just because there's not this voice up on the panel, is healthcare services that we haven't really talked about.
Yeah.
Is still really dry. The whole roll-up strategy of DSOs and physician practices is continuing to be dry, but that's just not a voice that we have on the panel. So
Yeah.
figured I'd add it in.
Yeah, right. And one that is getting public scrutiny increasingly as well.
100%.
Yeah. All right. So let's take some questions if folks have them for the panel. Any questions? Brave souls. No. Okay. We'll keep. Oh, here's one. Thank you.
Well, again, this kind of on the really anything that we see across our portfolio, not necessarily drug discovery. I mean, I think it's not altogether different. I mean, we're looking for differentiation always. So what's different about what this is offering versus anybody else? I think you're, on the AI side or tech-enabled side, you can think about it in different ways. In some cases, they have access to more or different or more valuable data than anybody else. So that's one way that they could be differentiated. For example, there's a lot of data in healthcare that's maybe locked away or hard to access and needs to be either bought up or created in some way or unlocked. And so some are differentiated based on purely the data that they have access to. Maybe they've generated the data in some interesting way. Others are using, it's truly their algorithms are superior in some way. They have some sort of breakthrough on the math of how they do some of these things, allowing them to be cheaper, faster, better in some way. So it kind of depends, but I mean, overall, it's about what they're doing that's different and what value that could bring to the space. Kind of a very high level answer, but.
I'd answer it this way. I'd say clear value prop. The way I think about that is alleviates a pain point. Second, there's a competitive moat. And then third, it's team. And the team is super, super important. And it doesn't mean that the team that's there now is all going to be in the exact same seats or the same roles, but we have to have alignment from the outset with where we're headed, have that trust factor, and know that there's going to be change over the hold period. And so that's one back to the one, I don't know, it was the first question around elongated diligence periods that I made. That's one of the benefits of spending months with a management team, and honestly, they're getting to know us just as well. Like, do they want to work with Wilson here? Am I going to be a good partner for the team? And sometimes there's a fit, sometimes there's not, and so we can't underscore that enough.
Team is huge.
I would say what I'm seeing is people pitching health tech that affects outcomes, right? That improves outcomes, but that's not proven. It's really just not proven. And some of them just have not thought about workflows, how it fits into the workflow. I mean, if it adds time to workflow, then it's no deal. So that would be a red flag for me.
Interesting. Another question? Oh, here's one. Yeah, go ahead.
Hi, I'm Sophia. I'm a third year pharmacy student. Thank you guys for taking it. I had a question more for the biopharma space. Wilson, I think you mentioned that you're getting patients that are higher quality and they're showing that they're more de-risked. What are those? What can someone include in pitch deck that you're like, yes, this is the change in higher quality, and how do you best show that you're a de-risked investment?
Good question.
You've stumped the panel. Good
Yeah.
job.
No, it's a good question. You can take it. Or if some,
I mean, if you're asking about biopharma specifically, a lot of the de-risking has to do with the data again. So the extent of data that you have that gives a reason to believe that this should have a high level of, to the extent that you can predict it. Biotech is inherently very risky moving from preclinical to clinical stage, but that you've done all the homework you could possibly do for the stage that you're at and that it looks very promising. Of course, all the other aspects of a good investment are true. Team, IP, is there a market out there that looks good? Is there an unmet need? Is there a reason for this thing to be? But in terms of the quality, for us, we spend a lot of time looking at the specifics of the data and the approach and all of that. So, but all the other things have to be true as well.
One thing I would add to that is that you have to de-risk in a timely manner because it's competitive. So China is now, I think, went from almost 0 to 39% of the out-licensing market in biopharma in like 2 years because they're able to de-risk very quickly. They run their clinical trials in like single hospitals because the hospitals there have like, 30 million patients or whatever. So it's competitive and speed matters because what could be innovative now could be not in a year from now. So I would pay attention to that.
I would add lack of concentration. I think a broad customer base that you've sold deeply into that continue to grow with you. That's one of the things, when we're looking at the data that we spend just a lot of time on. And, younger companies, they don't have those proof points. And so, they've grown with one client, and it's hard to then extrapolate that and take that leap of faith. And that can be a binary risk that we're not willing to take.
Mm-hmm. Up here in the very top.
My question is for Wilson. Going back to your point about healthcare services coming into physician practices, would you see physician practices more and more absorbed by health systems and limit the physician's individual purchasing power? How are you seeing those healthcare services companies able to differentiate themselves?
From selling? I don't really spend a lot of time, I guess, looking at those healthcare services. But it's a trend that from a health system perspective that they're becoming more and more system-like. And it's a way for them I feel like fundamentally they're trying to gain volume and provide access to patients. If you hear a health system talk, they're truly mission-oriented. And to me, when I hear the health system strategy executives talk, they're thinking about access points. So maybe dovetailing into kind of my world as we see point solutions often that are along that continuum of care that maybe are outside of acute care, which again, I reference kind of the EMR footholds are really hard for us to invest in that space. But as you think about the continuum of care continuing, that provides opportunities for us. Post-acute, home health, and I could go on in terms of as they become more and more system-like.
Interesting. Great. Over here.
Thanks for the insight, guys. I work for UNC Health System Corporate Fund, so we invest Series A, Series B across life sciences. And we've seen multiple cases over the last 6 months of Series A valuations that are, in some cases, north of $500 million. And it's largely driven by AI
Yeah, a little bit. Again, in this, especially the AI arena, as we were talking about, we do see some of these large valuations for things that are very early. And yeah, I mean, I think it's just you, as you know, when you have a valuation like that, you're going to get a lot of questions about what your business model is going to look like to provide a really good return on that valuation and when. And if you don't have a good answer for that, then you're probably not sitting at the right valuation. And that's not good for anybody, the company or the investors, to have an overly inflated valuation for what they could really deliver on. But there's a lot of belief now in sort of, again, really seismic shifts, I think, in the space. And some people think that, you know, you're gonna need to have some of these companies that are doing very major differentiating things. Like we all heard about the company Lila, which is doing like automated lab work essentially. That's a big idea, and I think it remains to be seen if it comes to truly work the way that the founders and investors envision. It really could be huge and transformative for the entire space. But it's a big bet to make. So I don't know. I think there's cases where some might be truly hyped up a little bit too much, and there's probably going to be a correction for that. There might be some cases where, you know, things really do kind of go to the moon, and I think it's going to be maybe a case-by-case sort of situation.
Just added the case by case. This is maybe more anecdotal, but if you look at ambient scribing, it's like 80% adoption rate in the last like 6 months, and I think it speaks to AI solving practical workflow examples that I think you referenced a couple of years ago in the peak, and digital health that really wasn't solving anything for anyone's daily lives. And I feel like there's examples of AI that give me confidence that maybe we're not going back there, and that kind of is your case by case point.
Yeah, so we got burned because we were early investors in, at the time, what became one of the largest AI drug discovery companies that I'm not going to name. They didn't have their business model worked out, and we didn't ask the right questions because a lot of healthcare data is proprietary. And there are privacy laws, and it's very IP intensive. So they were training their AI off of academia, which is not commercializable, a lot of it. So we got burned on that. So I think it's very important to have the technical due diligence, do a very good review of what you're looking at.
Oh, that's really interesting. Yeah, so that's like a fundamental legal risk to probably people just weren't fully appreciating at the time, right? Yeah, interesting. Yeah, question here. Yeah.
Sure. So a theme that I've been hearing today throughout the conference is government cuts that are potentially leaving firms strapped for cash. And I think a classic example is rural hospitals that may be struggling in their region, looking for potential acquisition. What would you consider when looking at a firm that might not present the 1.5 to 5 times growth, but is looking for an acquisition? Would you pass up on it? Would you acquire? What would be some factors you would look at that?
You preempted a question I was going to ask, actually, which is sort of this broader policy question. I mean, like, the healthcare industry is a highly regulated industry, and also globally, complicated from a policy and regulatory, perspective. So how do you all think about, specific issues like this, but just more broadly, policy issues? It just seems so complicated to me. So I don't know if anybody wants to take this first question, and then we can talk more about the policy side.
Are you asking about rural hospitals?
I think that's an example, but
Oh, okay.
picture is firms that are looking for potential acquisition that might not give the growth potential in the future, but it's an acquisition opportunity. How would you evaluate that?
Yeah, I think you can find great investment opportunities that that maybe the upside isn't as great, but you can feel really, really solid that it can continue doing what it's done for the last 15 years, so to speak. And so maybe the return band's a little bit different. And those are attractive. Those are very attractive. And then the other unique thing is that when you can bring M&A to the picture, so if you can acquire a really stable, steady, it's maybe a niche asset in a small market, call it like it's a $40 million revenue business and a $100 million TAM. You're like, this is a really niche business. But if you can do a unique M&A combination that unlocks a $500 million TAM and you're able to go penetrate that, that's interesting. And so from a return standpoint, I think we'd say, look, the downside's pretty, there's a good floor there. But if we're able to pull one of these two levers, this becomes really attractive. And it's a good, and that, of course, that's a great story for fundraising. The LPs love, oh, we were creative. We unlocked a unique value lever that only we could do based on our relationship network and the operating advisors that we brought to the fold. Quickly on your regulatory point, I think the way that we think about it is it's actually, it drives change in the industry. So from an investor standpoint, it's not necessarily a bad thing. I mean, if you look at, you know, all the different major acts, you know, kind of on a 5-year period and the investable trends that resulted from each of those. But I think it speaks to, as an investor, you have to be immersed in this space. You can't dabble in healthcare. You have to be all in. And you know, so some people are tech investors, and healthcare is kind of a sector that they spend time in. To me, I think that's maybe not the best approach. Or they're healthcare investors and they spend time across, you know, services, tech, biotech. Those are all very different. And so I think specialization is something that's is paramount as a result of the regulatory overhang.
Yeah, to deal with that complexity. Yeah.
I think we have to pay attention to Medicaid, right? And well, and very recently, the affordable ACA reimbursements. That affects things in a major way. If you're talking rural hospitals, could wipe them out. So then you have to think about impact investors, which is a very different type of investor, right? So I would think in that direction. I mean, even not rural, but community-based hospitals are having to partner so that to improve their margin profile with, you know, private specialized clinics and clinic chains to attract a different segment of patients. I'm sort of careful not to name names, but
yeah. But I want to zoom out a little bit, because I mean, I think, you know, in some ways, investing, like the value, a big part of the value creation is innovation, right? And especially like in tech or in VC, it's all innovation. But the world has very different regimes for how it thinks from a policy perspective about how, I mean, do you see that? I mean, when you're looking globally, I mean, you mentioned you're active in Europe and Asia as well. I mean, how important is the policy regime in terms of the opportunity to generate investment returns from innovation?
I spent a lot of time in the UK, and I think we were just talking about, you know, NICE in the UK, it sets prices because of the massive bargaining power of the healthcare system in the UK, right? But they tend to be very conservative in terms of funding innovation. And so the outcome is, you know, when the UK was part of the EU, a lot of British patients would travel to France for cancer treatments because that's where they have access to innovative products, whereas in the UK they don't. So it's a trade-off.
Yeah.
And it has a huge, huge impact on investments. I mean, I don't think we need to mention the major healthcare companies that have left the UK recently, right?
Yeah. And then certainly on the venture side of things, I mean, it's just so expensive. The regulatory process can just be so expensive. I mean, how do you think about policy issues around that?
Yeah, it's a very important topic, and I think the very worst thing is uncertainty. I think everybody's hesitant to do anything when there's regulatory uncertainty or uncertainty. I think this year was a little bit challenging for folks because until sort of a few things we figured out where things stood on them, people were kind of nervous to act. But I think right now the FDA, I think we're landing in a pretty good place. I mean, there's a big emphasis on common sense and trying to make things more efficient. And I think there's a lot of rational kind of things being done there. I think there was some uncertainty earlier in the year, but I think people are generally feeling pretty good about where the FDA is at. I think you can break it up into different components, right? So there's like the FDA, and then you have the NIH. I think there was a lot of worry about funding cuts and things like that. I think that that seems to be landing also in, I think, a less terrible place than people were thinking earlier this year. But certainly there is still some uncertainty around funding, and that's affecting a lot of researchers. And of course, a lot of our substrate comes from the universities. The sort of arguing between the government and various high-level higher ed institutes has not been a positive. The sort of resulting brain drain or people leaving, researchers leaving, which is a very real sort of statistic, has not been a good thing. Then you have sort of the CMS side, the price setting side. So this whole most favored nations pricing was a big risk. I think now that's sort of been proving out to be a little bit more bark than bite. People have sort of been figuring out how to negotiate through that. The IRA is mostly good. There's still sort of a pill penalty around sort of for those that don't know, I mean, the time frame for when the government can negotiate prices for Medicaid, Medicare is 13 years for a biologic and 9 years for, an oral therapeutic, so a small molecule or pill. A lot of people think that's not fair or not good, and there's really no basis for that. And if you could have the innovation that gives you the same results with a pill versus an injectable biologic, that's usually a good thing. But I think a lot of people think that's going to be ultimately fixed. I think, pricing around things like, there's been a lot of discussion around pricing for Ozempic and things like that. It's probably not going to go as low as people are saying it's going to go. And then maybe if you take it lower, you could have a bigger market. So I think that's a little bit TBD how that's going to play out. But I think overall there's been some fears that have mostly settled down, I think, by this time in the year with the new administration. But all those things are very important. And of course, we've talked a lot about the China sort of situation, kind of nationalism sort of things. Some good, some bad. I mean, I think to some extent being, called to compete with somebody who's becoming a more formidable competitor could be a good thing. So we'll see where it goes from here. But I think in general, people are sort of feeling pretty okay with where we are right now.
So we're almost out of time. So one last word from you, Wilson.
Yeah, I'll jump. I think just on the regulatory piece, it's important to step back and recognize the real durable trends of what the government's trying to accomplish and not get lost in the year-to-year administration uncertainty. On the payer-provider side, I would summarize those as access, interoperability, and risk sharing. Pharma is a whole nother world that you guys are much more versed to talk about. But if you those are kind of undeniable that between administrations, those are long-term 10, 15-year trends that the government's trying to accomplish. And from investor over long horizons, that's kind of how we think about it.
Right. Well, I'm going to take that as a positive note to end on, that things are not as terrible as they were feared, and uncertainty is going down, and hopefully we continue to see more investment in the space, and especially more exit activity in the space, which I think will make both people on both sides of the table very happy. So please join me in thanking our panel today for a fascinating conversation. Yeah.